The S-Corp is the most overhyped and most misunderstood move in small business taxes. Done at the right time, it can save you $5,000 or more every single year. Done too early, it costs you more than it saves. So let's run the real numbers. How the S-Corp actually works, where the savings come from, and the income level where it starts to pay. Let's break it down. First, what an S-Corp actually is, because it's not a company type you form at the state. It's a tax election you file with the IRS, usually on top of an LLC, using Form 2553. Your business stays the same business. What changes is how the IRS taxes the money coming out of it. Here's the problem it solves. As a sole proprietor or regular LLC, every dollar of your profit gets hit with self-employment tax, 15.3% for Social Security and Medicare. Make $100,000 of profit, and roughly $14,000 of it goes to self-employment tax before income tax even starts. That's the pain the S-Corp attacks. The S-Corp changes the rule. As an S-Corp owner, you split your profit into two buckets. Bucket 1, a salary you pay yourself. That part still gets the 15.3% as payroll tax. Bucket 2, the rest, taken as distributions, and distributions do not pay Social Security or Medicare tax at all. That second bucket is the entire savings. Before you get excited, there's a rule that holds the whole thing together, and it's the one the IRS polices hardest. Your salary must be reasonable, roughly what you pay someone else to do your job. You cannot pay yourself $5,000 a year and take $95,000 in distributions. Set the salary too low, and the IRS can reclassify your distributions as wages, hit you with back payroll taxes and penalties, and unwind your savings. And here's the form it all lands on, the 1120S, the S-Corporation's own tax return. Straight from the IRS, this is a real, separate business return you now have to file every year, on top of your personal return. Your profit flows from here to your personal return on a Schedule K-1. More power, more paperwork. Which brings us to the honest cost side, because the S-Corp is not free. You'll run payroll software or a service, usually $500 to $1,000 a year. You'll file that 1120S, typically another $500 to over $1,000 in prep fees. Add state payroll filings, unemployment insurance, and bookkeeping that has to be tighter than before. Realistic all-in, $1,500 to $3,000 a year. So the whole decision is one comparison. Is the payroll tax savings on your distribution bucket bigger than those running costs by enough to be worth the hassle? Below a certain profit, it isn't. Above it, it clearly is. Let's find that line with real numbers. Example 1, $100,000 of profit. As a sole proprietor, your self-employment tax is about $14,100. Now elect S-Corp and pay yourself a reasonable $50,000 salary. Payroll tax on that salary, about $7,600. The other $50,000 comes out as distributions, no Social Security or Medicare tax at all. Gross savings, about $6,500. Subtract, say, $2,000 in payroll and filing costs, and you're keeping roughly $4,500 every year for doing the same work. At $100,000 of profit, the S-Corp is clearly worth it for most people. Example 2, $40,000 of profit. A reasonable salary for your work might be $35,000, leaving only $5,000 in distributions. The payroll tax savings on $5,000 is about $700, but the S-Corp costs you $1,500 to $3,000 to run. You'd be paying $2,000 for the privilege of saving $700. At this level, the S-Corp loses. So where's the line? For most solo businesses, the S-Corp starts to make sense somewhere around $75,000 to $100,000 of consistent yearly profit, the point where the gap between your profit and a reasonable salary gets big enough that the savings clearly beat the costs. Below that, keep it simple. Well above it, the election is usually a no-brainer. A few more things that change the math. Your salary, not your distributions, is what counts for Social Security benefits later and for how much you can put into a solo 401k, so a smaller salary isn't free. Some states tax S-Corp extra or don't recognize the election, and the 20% QBI deduction generally still applies. It interacts with your salary, which is another reason to set it thoughtfully. Timing matters too. The election generally needs to be filed by March 15th to count for that same year, file later, and it usually starts the next year, though late election relief exists if you qualify. The clean play: decide in the fall, get payroll set up in January, and start the year as an S-Corp. So here's your decision checklist. Is your profit consistently above roughly $75,000? Is there a real gap between that profit and a reasonable salary for your work? Are you ready to run payroll and file a separate return? And have you actually run your numbers, savings versus costs, instead of copying someone on the internet? 4 yeses, and the S-Corp probably pays. Quick recap. An S-Corp is a tax election that splits your profit into salary, which pays payroll tax, and distributions, which don't. The savings are real, but so are the costs. Payroll, a separate return, and a reasonable salary requirement the IRS enforces. It usually starts paying around $75,000 to $100,000 of consistent profit. Below that, keep it simple. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, so every figure here is checked against the IRS sources. It's always educational, never advice for your specific situation. Bottom line, the S-Corp is a powerful tool with a price tag, a real saver at the right income, a money loser too early. Ignore the hype in both directions, run your own numbers with a pro, and make the switch when the math, not the internet, says so. This is general education, not tax advice. Subscribe to the Tax Breakdown for simple tax-saving tips before you file.